As we look at the boards right now, Affirm Holdings is trading at 77.57 USD, which marks a significant intraday slide of 4.23, or about 5.17% today. While a 5% drop might look like a standard, volatile day for a high-growth fintech name, the narrative under the surface is far more complex than a simple sell-off. Most people watching the ticker today probably expected Affirm to be catching a massive tailwind following the news that broke regarding a potential 10% cap on credit card interest rates. That headline initially sent shockwaves through the banking sector, causing major lenders to stumble, while fintech players like Affirm and SoFi initially saw a spark of optimism. However, the reality we are seeing in the price action suggests that the market is beginning to question the long-term implications of such a drastic regulatory shift. The curiosity loop here isn't just about whether a firm wins because credit cards lose. It is about whether a 10% cap would force traditional banks to tighten their lending standards so much that a massive wave of subprime and near-prime consumers suddenly flood into the buy now, pay later space, or if the entire credit ecosystem is about to face a liquidity crunch that no one is prepared for. If you've been following the broader market, you know the general sentiment around Affirm has been one of cautious optimism throughout the early parts of 2026. Many investors view Affirm as the modern alternative to the traditional debt trap, offering transparent terms and fixed payment schedules that appeal to a younger demographic that is increasingly wary of the revolving debt cycles associated with big banks. The expectation was that as Affirm deepened its ties with giants like Amazon and integrated further into the Apple ecosystem, the stock would naturally climb toward that $100 mark. But the reality is that Affirm is currently caught in a tug-of-war between its impressive growth metrics and the harsh realities of a shifting macroeconomic landscape. When you look at the performance of other major tech names, like how Tesla stock or Nvidia stock have handled recent volatility, you see that the market is rewarding companies with bulletproof balance sheets and clear paths to profitability. Affirm is getting closer to that GAAP profitability milestone, but as we see with today's 5% dip, the market is still treating it with the skepticism reserved for high-beta fintech assets rather than established tech titans. The recent movement we are seeing today is specifically tied to the news coming out of the executive branch regarding that proposed one-year cap on credit card interest rates. On paper, this should be a massive win for Affirm. If traditional credit cards are restricted in how much interest they can charge, they may become less profitable for banks to offer to anyone without a perfect credit score. This could drive millions of shoppers toward Affirm at the point of sale. We saw a similar dynamic play out when investors were looking for investment help during previous cycles of high inflation. They flocked to platforms that offered more predictable outcomes. If you are using an individual brokerage or exploring various investing sites, you likely noticed that the initial reaction for AFRM was a 3% jump in the pre-market, but as the trading session matured, the reality of the situation set in. A 10% cap is a double-edged sword. While it might push users toward Affirm, it also signals a period of intense regulatory scrutiny on all forms of consumer lending. Investors are starting to realize that if the government is willing to cap credit card rates, they might eventually turn their sights toward the fees and interest rates charged by buy now, pay later providers as well. This volatility is why many retail investors are shifting toward more automated solutions like Schwab Intelligent Portfolios or using a SoFi robo-advisor to manage their risk. When you're engaged in self-investing, it's easy to get caught up in the daily swings of a stock like Affirm, but the institutional activity we are seeing suggests a more calculated move. Large funds are balancing their exposure between high-growth fintech and more stable assets like Fidelity ETFs or Fidelity mutual funds. We are seeing a high volume of trades today, with Affirm's volume significantly higher than its daily average, indicating that this isn't just retail noise, it's a repricing of the company's risk profile in real time. If you look at the Interactive Brokers platform or the Fidelity Trading platform, the sell orders for Affirm are coming in clusters, often following broader sell-offs in the regional banking sector. There is a fear that if the banking sector is healthy, Affirm is a great niche player. But if the banking sector is under stress due to interest rate caps, the entire consumer spending engine could seize up. For those of you managing your own portfolios through a Robinhood app or a Fidelity brokerage account, it's worth noting that Affirm's business model is fundamentally different from the companies it's often compared to. Unlike a traditional credit card that relies on late fees and compounding interest, Affirm makes a significant portion of its revenue from merchant fees. This is why their partnerships with Apple and Amazon are so vital. When a consumer uses Affirm to buy a new MacBook through Apple Pay, Affirm is getting paid by both the consumer through interest, if it's an interest-bearing loan, and by the merchant for facilitating the sale. This dual revenue stream is what separates them from the pack and why they're often a top pick for those looking to invest online in the fintech space. However, the market is currently pricing in the risk that merchant margins might also be squeezed if consumer demand drops. We saw similar concerns with Apple stock earlier this year when people worried about iPhone upgrade cycles, and we're seeing that same anxiety reflected in Affirm's price today. I want to take a second here and ask for your input because the community sentiment often leads the market trend. Comment below how many shares of Affirm you currently hold, or if you're sitting on the sidelines waiting for a better entry point. Also, let me know if you think the proposed 10% credit card rate cap will actually help or hurt Affirm in the long run. Engaging with these developments is a huge part of being a successful investor, whether you are using Robinhood Investments or a more traditional Fidelity wealth management service. Now, let's look at what Affirm actually does beyond just the headlines. They provide a digital and mobile-first commerce platform by offering a suite of payment solutions. Their core product is the point-of-sale loan, which allows a consumer to split a purchase into 4 interest-free payments or longer-term interest-bearing installments. This transparency is their biggest selling point. They don't charge late fees, which is a massive differentiator in a world where credit card companies make billions off of consumer mistakes. This is why they have seen such high repeat usage rates, near 96% in recent reports. They have also expanded into the Affirm card, which is a physical and virtual debit card that allows users to pay in full or request to pay over time via the app. This product is designed to compete directly with the cards sitting in your wallet right now, and it's a key reason why users of the Robinhood Cash Management System or SoFi Active Investing platform are starting to take notice of Affirm as a legitimate financial hub. If we look back at their fiscal first quarter 2026 results, they were actually quite strong. They beat expectations on both the top and bottom lines, showing that they are managing their credit risk effectively even as they grow. Their real-time underwriting is their secret weapon. Unlike a bank that gives you a credit limit and hopes you pay it back, Affirm evaluates every single transaction individually. They use a massive amount of data to determine the likelihood of repayment in seconds. This is the kind of technical edge that investors look for when they are evaluating Nvidia stock or other high-tech leaders. They aren't just a lending company, they're a data company that happens to lend. This is why you see them featured so prominently on online investing platforms and why they are a staple in many Fidelity IRAs for growth-oriented investors. However, the reality of the older reports shows that Affirm has struggled with its valuation in the past. It wasn't long ago that the stock was trading at a fraction of its current price, and it has had to work incredibly hard to prove to Wall Street that it can be a sustainable business. The loss of the exclusive partnership with Walmart a while back was a major blow, but they have more than made up for it by becoming a default option for Amazon Pay and integrating with Shopify. If you're using a Fidelity mobile app or checking your Robinhood fractional shares, you can see how these integrations make Affirm almost inescapable for the modern shopper. But the risk remains that Affirm is still very much tied to the health of the consumer. If we enter a period where the K-shaped economy puts too much pressure on the lower income tiers, a firm's delinquency rates could tick up, which would be a major red flag for anyone holding the stock in an individual brokerage. Looking toward the future, the outlook for a firm is a high-stakes game of execution. We have the fiscal second quarter 2026 earnings coming up in early February, and that will be the real test. Investors will be looking to see if the holiday spending season provided the massive boost everyone is expecting. If they can show continued growth in gross merchandise volume while keeping their provision for credit losses stable, we could see a massive rally back toward the $90 range. On the flip side, if they show any signs of credit deterioration, the stock could easily test its previous lows. This is why many people are looking for investment help to navigate these waters, often turning to SoFi stocks or interactive brokers' trading tools to set stop losses and manage their downside. The scenario we are in right now is one where the market's expectation of a regulatory windfall is being met by the reality